Quick question. If you built 2,000 hours last year and made 300,000, what happens if you build 2,500 hours the next year? You make more money, right? Well, sure. But here's the problem. You just bought yourself a more expensive prison. Today, we're talking about leverage, the one concept that separates CPA farm owners from CPA farm employees who happen to own the business. And I'm going to show you the actual math that proves why working harder will never set you free. So let's go. I'm Ephraim Asher, and I help CPA farm owners get back their time so they can actually run their business instead of being trapped in it. We're in week three of this series based on David's master book, Managing the Professional Service Firm. And if you've been following along, things are starting to click. So, a quick recap of last week. We broke down the three types of work that exist in every CPA firm. The first one is professional work, the technical stuff, necessary but doesn't scale. You're capped at your own hours. The other one is managerial work, building capacity, training people, creating systems, coaching your team. This is where you start multiplying yourself, have other parts of you. The last one is leadership work, designing the firm, vision, strategy, client acquisition, client selection. This is basically where you're crafting your book of business. Here is where the freedom is actually created. And we discovered that most CPA owners spend 70 to 80% of their time on the professional work, the category with the lowest leverage. The exercise was simple: track your time for 1 week and label everything as P, M, or L, professional, managerial, or leadership work. And hopefully you did that. And if you did, you probably had a bit of a wake up call. So this week, we're going deeper. We're going to talk about leverage, what it actually means, and how it works in a CPA firm, and why the math of your business might be completely backwards. Because here is the truth: most CPA owners are optimizing for the wrong number. Let's fix that. But one, what leverage actually means. Okay, so let's start with the definition. When most people hear leverage, they think work smarter, not harder, delegate more, use technology, optimize more systems. And sure, those things matter, but Meister defines leverage very specifically. He says that leverage is the ratio of junior people to senior people in your firm. That's it. It's not a mindset, it's not a productivity hack. It's a structural decision about how your firm is built. And here is the formula. It says that leverage is equals to the number of junior staff divided by number of partners or owners. So let's say you're a solo CPA firm with two staff members. Your leverage is 2:1. Now let's say that you're a partner in a firm with three partners and 15 staff. Your leverage from to junior to partners is 5:1. And why does this number even matter in the first place? Because leverage determines how much profit you keep, how much time you have, and whether your firm can grow without you working anymore. And Meister puts it bluntly, he says, a firm's profitability is not determined by how hard the partners work. It's determined by how much work the partners can get done through others. So, what's the translation? You don't get rich by billing more hours, you get rich by building a system where other people's hours create profit for you. So, the math most CPAs get wrong. So I will show you an example of two scenarios here. Both real, both are common. One leads to burnout and one leads to freedom. In the first scenario, you have the high billing owner with low leverage. So you're a CPA firm, you bill 2,000 hours a year at $200 an hour. The revenue from your work is 400,000. You have one junior accountant who bills 1,500 hours at $100 an hour. The revenue from their work is 150,000 grand annually. Well, the total firm revenue, your work plus his work is gonna or her work is gonna give you just short of half a million, $550,000. So then you subtract you subtract your staff, overhead, rent, software, taxes, blah blah blah, and your take home is 390 grand. Not bad, right? But here is the problem. You just worked 2,000, 2,000 billable hours. Now, look, that's our 40 plus hour work week, 50 weeks a year. You're making good money, but you are the business. And I highlighted this. If you stop, revenue stops. Your leverage ratio is 1 is to 1. You have one person working for you, and you're working just as hard. The second scenario, scenario B, is the leveraged owner, the high leverage. Same starting point, but this time you make a different choice. You bill 1,000 hours a year at $200 an hour. So the revenue from your work is 200 grand, but you have five team members, two senior accountants billing 1,500 hours at 125 an hour. That's bringing you 375. And also, you have three junior accountants billing 1,500 hours at 85 an hour. That's 382 and 500. The total farm revenue short of a million, you just get 957,500. You subtract staff, 400, overhead, and some other necessary expenses. And you take home is 407,500. Now, you have to take a minute and like pause because you just realized you worked less in scenario B, yet you made more money while working half the hours. Your leverage ratio is 5 is to 1. You have five people working for you, and you're spending your time managing, leading, and designing the farm instead of doing the work yourself. This is mind blowing. It's the math that most CP owners never run. They think if I bill more hours, I'll make more money. Technically, it's true, but it's a trap because the more you bill, the less time you have to build the thing that actually scales. Other people doing the work. And Miser put it beautifully. He says the most profitable farms are not the ones where partners work the hardest. They are the ones where partners have built the highest leverage. So the three levels of farm economics. So if leverage is the goal, how do you actually build it? Miser breaks farm economics down into three levels. First, utilization, realization, and leverage. So let's go through each one. The first level, utilization. Utilization is simple. It's basically asking what percentage of available hours are actually being billed. If your team works 40 hours a week but only builds 30, your utilization rate is 75%. Most CPAs farm get around 60 to 80% of the utilization rate. And here's the thing, you can push the utilization higher. You can grind the team to 90, 95%, but he warns that high utilization without high leverage means everyone is busy. It doesn't mean the farm is profitable or sustainable. Basically, it's like you going back to scenario A and working 2,000 hours in a year, 40-hour plus work weeks. You're just busy, but it doesn't mean that your farm is profitable or sustainable. And if everyone is building max hours, but you still don't have the time for profit, you don't have a utilization problem. You have a leverage problem. The second level is the realization level. It's basically asking how much of your build time do you actually collect? You build 10,000, but the client negotiates it down to 8,500. Your realization rate is 85%. This happens when you write off time, you discount fees, you do extra work for free because the relationship matters, right? Low low realization is often a symptom of poor scoping. You take on the work without fully knowing what it entails. Weak pricing conversations, taking clients who do not value your work. And my mistake is realization is the tax you pay for not being clear about value up front. You take on you take on a $1,000 gig, but then you quickly realize that it's more than a $1,000 problem. You should be billing 2,000, 3,000, 4,000, 5, 6, and up. But because you want to keep the relationship, you're like, okay, fine. And it's a tax that you pay by not being clear about value upfront. If your realization is consistently below 90%, must say that you have a client selection or pricing problem. Basically, you're not getting the clients that you want, or you're pricing your fees just too low. Last one, the third level, leverage. This is the big one. Leverage is how much work are you getting done through other people. And here's what most CPA owners miss. Leverage is not just about having stuff. It's about structuring work so the right people do the right tasks. And he explains it like this. In a high leverage firm, partners spend their time on 20% of the work that only they can do and delegate the other 80%. Basically, the Pareto principle, 80/20, whereby 80% of your efforts come from the 20% of 80% of results come from the 20% of efforts that you apply to your work, business, sports, anything. And it's also beautiful that this same principle also applies to our firm. But in most CPA firms, the opposite happens. Partners do 80% of their work themselves because it's faster. Obviously, they don't trust anyone else, and clients expect the partner. And that's how you end up working 2,000 billable hours and wondering why you are always exhausted. You have no time to work on your family, goals, plans, nothing. So, here is the hierarchy. Utilization gets you busy. Realization gets you paid fairly, and leverage gets you free. Most CPA owners obsess over utilization. Smart CPA owners build leverage. Why CPA owners resist leverage? Okay, so if leverage is this powerful, why don't most CPA owners build it? And that's a good question to ask. And David puts it in, identifies three reasons for it. The first reason is I'm the best technician. You've been doing this for 15 years. You fast, you accurate, you catch things that others miss. You're a diligent worker. And every time you delegate, it feels slower, messier, riskier. And so you just do it yourself. And he says that by being the best technician is a competitive advantage for a professional. It's not. It is a structural liability for a farm owner. Being the best technician is a competitive advantage for a professional. So yes, you do want your CPAs to be the best in the business, but as a farm owner, it's a structural liability for you because then now you start working in the business, not working on the business. The other one is because you do more yourself, you build less capacity. Think a bit of going to war and you're going to fight this particular enemy. And if you do all the battles and your infantry is doing nothing, then which means that when you do have a big war and you do need the help, your infantry hasn't been trained. There's no one that knows how to fight well. And the chances of you succeeding in that war drastically reduces. And the less capacity you build, the more dependent your farm becomes on you. So you're not protecting quality, instead, you're protecting dependence. The second reason is clients want me. You're famous, the best CP in the world. Clients say things like, I feel better when you handle it. Can you just take a look? I trust you. I have a right feeling that you're the best one for this. And it feels like loyalty, but operationally, it's fragility. Meister's insight is a firm that cannot deliver value without a specific individual does not scale, it survives. Basically, as long as you're there, business campaign. But if you leave, go on vacation or just go away for a bit of time, the firm goes. If clients are attached to you personally and not your firm's system, You haven't built a business. No, no, no. You have built an expensive personal brand with employees. The third reason is I don't have time to train people. And this is the most common excuse. If I had time to train someone, I'll just do the work myself. But Master flips this and says that you don't have the time not to train people. Every hour you spend doing work someone else could do is an hour you're not building the farm. And here's the truth, yes, training feels slow, but doing everything yourself is way slower. Because when you do it yourself, you're buying short term speed at the cost of long term capacity. 6 months from now, you'll still be the one doing the work yourself. So, how do you start building leverage? How do you also start making sense of this? So let's make it practical. You don't need to overhaul your entire farm system tomorrow, like yank, but you do need to start shifting. And here are three ways to start building leverage this month. First, audit your billable hours. Go back and look at the last month of your billable time. Ask, what percentage of this work could someone else have done with the right training or system? And be honest. And I'm willing to bet it's a 60 to 70%. If I'm wrong, please do tell me in the comments. Master says that most partners do the work that's beneath their pay grade because it's easier, because it's faster in the moment, but it's never faster in the long run. Identify the top five tasks you're doing that someone else could learn, and that is your delegation roadmap. The second one is hire for leverage, not just for capacity. So most CPA owners hire when they're drowning, when things get hard, or when they oh my gosh, like we need to actually fulfill this work. Let's outsource this other stuff. So they hire when they're in trouble, right? Like buying it's like buying insurance when your car is already damaged, and they need help now. So they hire someone junior, then keep doing all the work themselves. And my advice is hire one level above where you think you need, because yes, it will cost more money up front, but it builds leverage faster. You wouldn't have to worry about training them, because then instead of hiring someone who needs 6 months of training, hire someone who can take off your plate, who can take work off your plate in 6 weeks. 6 months of training versus someone who can take work off your plate in 6 weeks. The ROI is faster and the leverage is real, and you get to do more productive work faster. The third one is standardize the repeatable work. Leverage doesn't work if every client engagement is a custom snowflake. You need checklists, templates, standard workflows, clear scopes. Master puts it simply. He says, standardization is not the enemy of quality, it's the foundation of skill. Standardization is not the enemy of quality, it's the foundation of skill. Pick one service you do repeatedly. Say, for example, like business tax returns. Document the process, build the checklist, then go out and train someone on that same process. Then do it again for the next service, one at a time. This is how you build a farm that works without you. So, the real goal. Here is what CPA owners get wrong. They think that the goal is to work less. That is not the goal. No, 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 no. The goal is optionality. You get to choose. Why? You get to choose whether to work less if you want, to grow faster if you want, take a vacation without your phone, sell the farm one day, work on the business instead of on it, retire, give the business to a new accountant. You get to choose. His final insight is freedom is not about eliminating work. I just love this. It's about eliminating dependency. Freedom is not just about eliminating work, it's about eliminating dependency. When your farm can run without you, you get to choose. And that choice is what ownership is supposed to give you. So, a quick summary of what we just covered is leverage is not about just working harder. So, what is leverage? It's a ratio of your junior people to senior people in your farm. It's not a mindset, it's a structural decision. The math is you don't get rich by building more hours. You get rich by building a system where other people's hours create profit for you. We looked at two scenarios whereby the low leverage 1 to 1. You work 2,000 hours, make 3,090K, and you're trapped. You have you and you one junior accountant. Yeah, high leverage. You work 1,000 hours and you make 407,000. Free. You work less hours, $1,000 an hour. Or you work less hours and you get paid more because you have more people doing the actual work. So the three levels of farm economics. The first one is utilization. How much time gets billed? This is your busy work. With the realization, how much do you collect? This basically gets you paid fairly. How much do you take from a client? And the last one is leverage. How much work gets done through others? And this one gets you free. Why CPA owners resist leverage? I'm the best technician, but that's a liability, not an asset. Clients want me. That's fragility, not loyalty. I don't have time to train, but you don't have time to. But you don't have time not to train someone. So how do you start building leverage? First, audit your billable hours. What could someone else do? Second, hire one level above where you think you need. And the third one is standardize the repeatable work. The real insight here is leverage isn't about working less, it's about eliminating dependency so you have a choice. And the choice is what ownership is supposed to give you. So, the action step for this week is go back through last month's billables time, identify the top tasks that someone else could have done with training. Write them down. And from there, that's how you start your delegation map. And then next week, we're tackling something that might sting a little. Why technical excellence alone will never scale your firm. Because here is the uncomfortable truth. Being a great CPA and building a great firm are two completely different skills. And most CPA owners are trying to scale their technical skills instead of building a scalable business. So we're going to break down why being the best can actually trap you, the difference between expert and entrepreneur, and how to transition from craftsman to architect. It's going to be a good one. But before then, do the exercise. It's meant to help you. If it's meant to help you grow your farm, help you understand what places to work on, so you can actually get results for your farm, and instead get the optionality that you all want to have. So look at your billable hours. Find the work that you should be delegating, and start asking, what will my farm look like if I stopped being the bottleneck? All right. Thanks for watching. Now, go build some leverage.